All right, so with the debt ceiling drama just about over, all eyes are back on the Fed. That's what we've been talking about. Right now, at this moment, the Fed now sees a 35% chance for another rate hike. Remember, though, this morning it was 70%. We had a couple of members of the Fed, Jefferson and Harker. They started to talk about that and maybe a pause. I'm going to bring in Bianco Research President Jim Bianco. And Jim, you actually have pointed out that the Fed funds market has an amazing track record within 10 days of predicting rate hikes or rate cuts or whatever. So it's back to no cut, a pause for this next meeting. What do you think?
Well, the fancy word they're using is skip, meaning that
right.
they're not done raising rates. They're just going to raise rates at the next meeting. But it is all over the lot, and we still have the payroll report on Friday. And remember, it's beaten expectations for 13 straight months. If that's a 14th straight month of beating expectations, we'll probably put the rate hike back in the market if we don't for the rest of the day. As you pointed out, we were at 70% this morning. We're at 35% now because a couple of Fed people have said the word skip. It shows you how unsure the market is. That's one word from two different people, and you have a massive change in the odds. And that's because there's no conviction in this market as to what the Fed's going to do.
And some of that's on the Fed, though, right? I mean, a lot of it is on them. They supposedly take pride in messaging. They've gone out of their way to sort of do this endeavor. All these FOMC meetings are two-day meetings now, and they really go out of their way. But I feel like they're just too guarded. I wish they would just give us plain speak. You know, skip is a good word. Use more words like that.
Yes, you're right. That they kind of overmanage their communication. And when you overmanage communication, you get people that are either confused or misread them all the time because they think little words have big meaning and big words have little meaning, and they get all messed up. But right now, the market is really unsure as to what's going to happen next. Remember, we're already well above 5% on the funds rate. And if they were to raise rates again, we'd be near 5.5%. And the Fed is worried that there might be a slowdown in the economy coming. And they're also worried that they're not seeing signs that inflation is returning to 2%. So does the market. And that's why you've got all this confusion. And their communication is not helping it right now.
So you mentioned the 13 times, right? And by the way, I just think the fix is in with these estimates. It's embarrassing. But we did see massive revisions to the last 2 months. And so we got 188, which might be a low number coming from 250. By the same token, it feels like maybe someone's worried about these revisions. What if we get the other way, Jim? What if it's less than 180 and we continue to get even more revisions to the downside?
Well, then we'd have the first sign in a year that you've actually got a weakening payroll or a weakening labor market. Because up until literally the JOLTS report this morning, I heard you talking with KRV about it, is that the data, I like to joke that the problem with the labor market is there is no problem with the labor market, and that doesn't sit well with the Fed. And if we were to get below 180 and a revision down, and you're right, we've been seeing the revisions go the other way, we'd get the first real signs that the labor market is weakening, because right now we don't have that.
Hey, before I let you go, the debt ceiling deal, you're really one of the best when it comes to unpacking things like this. Just your thoughts on it. I mean, was it worth all the drama, all the nail biting, all the gnashing of teeth?
I don't think it was, because I don't think they got a whole lot out of it. And I would point out to you that there's going to be another side of this, and that's going to start next week. When they pass the debt ceiling, they're going to have to sell $700 billion to $1 trillion worth of Treasury securities in 5 or 6 weeks. That's a whole lot of buyers they're going to have to find for those securities in a short period of time. And there could be some kind of a squeeze that goes on in the Treasury market on the back end of this. This is what we saw the last time we had a debt ceiling in 2021 as well.
All right. Jim, thank you so much. Always appreciate your expertise, my friend. Folks,
thank you.
We'll be right back.